It has been 10 years since the financial crisis, and it seems like certain senators have some, well, short memories. Maybe they forgot about Lehman Brothers and other massive financial firms that either went out of business or got bailed out by hundreds of billions of your tax dollars. Well, today, the Senate, they voted to advance a bill that would roll back some of the Dodd-Frank provisions that were put in place to protect the economy from the next financial crisis. Now, the vote was 67 to 32, which means it needed more than a half a dozen Democrats to sign on. The bill, it is mostly aimed at moderate-sized banks, but the Times explains how this bill could have major ramifications. Quote, a little notice provision which creates a small exemption to a capital requirement meant to prevent banks from running into the same type of financial crunch that helped tip the economy into the Great Recession is being seized on by major banks, including Citigroup and JP Morgan Chase. They are pushing to expand the exemption in a way that analysts and former government regulators say would undermine a central pillar of the Dodd-Frank law. Banking reporter Emily Flitter, she co-wrote that piece, and she's kind enough to join us now. Emily, thanks for the time.
Thanks for having me.
Well, let's go back a little bit. Explain to our audience again what the whole point of Dodd-Frank was and what it actually did.
Well, the important provision of Dodd-Frank is a section that creates a requirement for banks to hold capital on their balance sheets and not do anything with it in accordance to how many financial products they have on their balance sheets. So if you're a bank and you have deposits and then you have some structured products and you have some government bonds, all of those things are assets on your balance sheet. And so you need to hold an appropriate amount of capital to offset those in case some of those assets start to deteriorate in value. The whole point of the rule is that it doesn't matter what type of assets are on your balance sheet. You have to hold the same amount of capital. It's just the total size. That's the general rule. Right now, banks want to change that so that a certain really small sliver of those assets are exempt from this rule.
Now, as you said, and we quoted even from the piece that you co-wrote, there was a provision that was really targeted for those mid-sized banks here that seemed to have pretty strong bipartisan support, which was a change that wouldn't certainly change the expectations of the bigger sized banks, but would be more restricted to those. And potentially the bigger banks, or at least some of them, are trying to seize upon that. Some say that at the end of the day, this is really just a tweak. Others are saying, no, this is the beginning possibly of a slippery slope, but much more substantive in terms of changes as it relates to banks. At the end of the day, what was your takeaway, what they're trying to do? How important or seismic could it be?
Well, I think the really interesting part of the provision that is at issue here is that it actually isn't central to the bill. The bill is designed to make it to sort of free up some restrictions on small and medium-sized banks. They used to have to go through the same regulatory, hoop jumping that the biggest banks do. And that was something imposed on them after Dodd-Frank, and it was just based on how big they were. And so this sort of raises the limit, the size limit, and says to the small and medium-sized banks, it's okay for you to grow without getting tangled up in these regulations that are really for institutions that are systemically important, which means that if they fail, the whole system could fail. So in this same bill that's just basically supposed to do that, to ease the restrictions on these smaller institutions, there's one provision that is it's not the same easing, it's actually a carve-out. It says, this other rule that said that you had to hold all this capital, we're going to give you an exception for this one type of asset. And it only applies to banks who do a really narrow, boring sort of business. And the big banks are really trying to get in on that rule. And so to the question about how big a deal this is, I think the biggest elements of this are that no matter what happens with this legislation, because of how this small exemption is worded right now, the banks are going to be able to hook onto it and say, this isn't fair. We need more legislation. We need more changes, and we want to actually make bigger changes to this bill. And that's what they can start to do even after this passes. It's going to be a focus point for them to be able to say, we're not happy with how the regulations are. And that's something that they weren't able to do after the financial crisis. They weren't able to just start attacking these new regulations because there were so many new regulations, and they were all designed to make everything safer, and there wasn't really a good narrow focus. But this provides the focus. I think that's the most important part.
You know, Emily, and this is very much in the way of anecdotal, but I have always been shocked, and you cover this as a beat, off-camera people in both social settings, whenever I'm talking to people in the financial sector, including in institutions that required bailouts to stay afloat after '08, I've always been shocked, almost universally, at the lack of any contrition, and more than that, an almost palpable resentment that they were labeled as the bad guys here with the crash that happened. Obviously, with how the Senate decides to vote, there's a regulatory element they have to decide, but also there's a public pulse as to how much forgiveness or willingness on the part of the public there is to basically give the benefit of the doubt to these institutions again. Have you been struck at all, if not by the tone deafness, by, I believe, a misread from the financial sector at how much has been forgiven and forgotten since '08?
It's a really interesting point that you make. During the financial crisis, I was a banking reporter in Washington, and I watched as bankers floated different theories about who was really to blame. And of course, there was nobody who stood up and said, you know what, it was us, we made this big mistake, and we're really sorry about it. Of course, that's not how business in general works. It's never a good idea to raise your hand and accept blame for something. But I think with this bill, it's really a sweet spot for the banks because they aren't actually, they don't have to say we're not sorry. They don't have to say, you know, we've been abused. They can start out by saying there's a really sort of simple technical fix here that we all deserve, and it actually lowers the stakes for them in terms of the big blame game. And the surprising part of that is that it will set the tone going forward so that they can actually take this more neutral argument and apply it to other things and just slowly weaken or broaden the exemption, slowly weaken the rule or broaden the exemption without a big combative stance.
I guess more broadly, my question is, when the dust settled, but not long after the crash, you know, you talk to these guys and you say, you know, explain some of these synthetic products, and they couldn't even do it. And then when you talk about the subprime mortgage crisis, it's, well, hey, it's the government's fault, or people shouldn't have borrowed money they couldn't have paid for. The lack of, as you said, willingness to say, the buck stops with me, I get it. But if there isn't an understanding about how it happened in the first place, and could happen again if we're not careful, then, you know, the approach would be far different. Is there at least an acknowledgement from the folks you cover that it's not unthinkable we could have an '08 all over again if we're not careful here, and we need regulation? Or do they believe that it was such a one-off that all this over-regulation from the government is just that?
Sure. I actually think that every one of the major banks, if you talk to their lobbyists in D.C., would say, yeah, we did need a little bit more regulation than what was in place before the '08 crisis. In a way, that's a good place to start for them because it helps them start to talk about specific things that they want changed without seeming to, you know, attack everything. So I don't think that it's very significant that any one of the banks would admit that some of the regulations have been good. They obviously have lots of things that they would change, and they just want to seem reasonable. The things, however, that they do want to change don't go anywhere near asking for a return to the wild days of, early
Yep.
2007, for instance. Nobody's trying to fire up the synthetic credit market in quite the same way anymore.
Well, let's hope. Emily, I certainly appreciate the time. Thank you very much.
Thank you.
And coming up next, everyone, we're going to come back to our top story, that nor'easter bearing down on us. And it all happens as thousands of people in our viewing area still have not recovered and gotten power back since the last one. We're going to tell you what to expect from round two.